If I take it back a little bit further than that, for the past 5 years prior to this year, fixed income returns have been double digit, which has been great for fixed interest customers and unit holders. And that was because of the global financial crisis and because of the fiscal debt crisis in Europe. What we've seen now is an easing in those crises, and as a result, we've seen yields start to rise a little bit around the world in bond yields, and yields this year have been in the lower single digit area. And that's despite the central banks around the world flooding the markets with a lot of liquidity. There's been some confusion in the marketplace about what the Federal Reserve's doing, given that they just recently decided not to taper in September. My understanding is the US Federal Reserve is waiting for more economic data, and the recent data has been a little bit on the soft side, and it wasn't quite enough for them to go ahead and proceed with tapering or starting to take back the liquidity that's in the marketplace. The other concern that the US Federal Reserve had is that the impending discussions in Washington, particularly in Congress, to do with the fiscal impasse that's occurring. There's still a lot of discussion happening between the Republicans and the Democrats. That issue hasn't been resolved by both parties. The Federal Reserve is quite concerned about that and also mentioned that in its statement. We still believe that they're going to taper, possibly next month or in December, but a little bit more stronger economic data and some resolution on the fiscal impasse would see a resumption of the Federal Reserve's commencing tapering. It's very difficult for the bond markets to put in place an investment strategy because it's a highly political decision on the fiscal impasse. You've got discussions going on between the Republicans and the Democrats. If there isn't any resolution, on the one hand, what may happen is that markets decide to sell down their assets, particularly their US government bond holdings, on concerns that the US could default on its sovereign bonds, and that money could be redirected to German bonds or English bonds, or it could even go to Japanese JGB bonds, just to be out of the US where the issue is unresolved. If the issue, on the other hand, gets resolved pretty quickly by the politicians, then we should see the markets return to looking at economic fundamentals and placing the appropriate fixed interest strategies in place. Australia's in a quite interesting position at the moment because the rest of the world is recovering from the crisis that we've seen overseas, from the global financial crisis and the European sovereign debt crisis. So we're seeing the world outside of Australia bottoming out and starting to pick up, and we're starting to see bond yields around the world start to begin the process of normalising. This is in contrast to Australia, where we've seen and heard about the end of the resources boom, particularly with the slowdown that's happening in China. And as a result, there's concerns that Australia may slow down in the next 12 months. And that's why there's a lot of speculation, is there going to be further interest rate cuts like we've seen in recent months in Australia. Now, the Reserve Bank of Australia doesn't want to do any more rate cuts in Australia because the market is already fired up for residential property, and further rate cuts is only going to further heat and possibly overheat the residential property market. What the Reserve Bank would rather see is for the Aussie dollar to fall, and if the Aussie dollar does fall, it helps stimulate local industry and also helps improve particularly our export sector in Australia, and that will help improve growth at a time when things are slowing down. So there is a preference for no more rate cuts and for the Aussie dollar to do the work of stimulating our economy at a time when things are slowing. If the Aussie dollar was to continue to rise and not actually depreciate, then the RBA would have to ascertain whether another rate cut would be needed, and if it would actually work in the current economic circumstances in Australia. Our position at this stage is we're following what the RBA is attempting to do and help and see if the Aussie dollar will come down, and so that there is no need for any more interest rate cuts in Australia.